Thank you guys so much for joining us. My name is Caroline Scannell. I'm the Director of Brand Development at Paper Chase. This is our second restaurant finance webinar specifically geared for the UK and the Middle East. Today, we're going to be talking about taking the next step for your hospitality business. So what happens when you have one or two successful concepts and are looking to open up more locations and look down the path of raising funding. So we have some wonderful team members from Paper Chase here to guide you through this process. But first, a little bit of housekeeping. If you don't know who Paper Chase is, we are your restaurant's accountants. We've been in the business for over 30 years. And the reason why we like to give free resources like this is because we truly believe that sharing our knowledge will create a richer industry and will help uplift our own clients, but also the industry at large. If you have any burning questions during the webinar, you can feel free to drop those in the chat. But in general, we ask if you could please hold those until the Q&A. We'll have a full-on Q&A afterwards that will allow you to ask any questions specifically also about your business. But without further ado, let's get started with some introductions. So I'd like to introduce Dimitri and Simon. Go ahead, guys.
Thank you, Caroline. And thank you all that have joined the call. My name is Dimitri Khrushchev. If you happen to notice an accent during this webinar, I grew up in South Africa. And if you're happening to wonder why a South African would be called Dimitri, it's because I'm originally from Bulgaria. And my journey in America started when I moved over for a tennis scholarship to play at Cal Poly in San Luis Obispo. Upon graduating, I started my career in finance as an equity research analyst, and my hospitality finance career began about 6 years ago at Triple Enterprises, a Paper Chase acquisition almost 2 years ago. I worked in corporate finance roles over the last 6 years, helping clients with M&A advisory, both on the sell side and the buy side, some fundraising advisory for both growth equity and debt financing. We also provide clients with fractional CFO and FP&A services. I joined Paper Chase about a year ago, helping build out this corporate finance team with Philip Gay. And our team has been working over the last year with clients to prepare board level presentations, investment materials, and fundraising and M&A materials. I'll hand it off to Simon for his intro.
Hi all, thanks from me as well. Thanks for coming. I'm looking forward to meeting some of you at the Q&A afterwards. But in the meantime, maybe some of you already know me. I'm the executive chairman of Paper Chase, but I've been in the restaurant business for a long time. And I'm going to try and speak to you not as an accountant, which I'm not. I'm one of the only people in Paper Chase that isn't an accountant, but as a lifelong restaurateur. So I've often raised money for restaurant businesses, usually my own, sometimes other people's. And I've learned a few things along the way that we're going to try and share with you today. Some of the things we're going to cover today are just the sort of the general steps. So we've got prove existing concepts, standardized systems and processes, strategic planning for your capital raise, valuation, financial modeling, and investor materials. So what do they mean? Prove existing concept. What we're going to do today is we're going to picture a restaurant that already exists, and it's called Caroline's Cafe or Caroline's Bistro. I can't remember quite what the last thing was we said, but anyway, but it's Caroline's. And it already exists, and it's on a high street, and it's got a turnover, and it's got customers, and the owner, Caroline, would like to expand. That's going to be the premise that we're going to be working on today. We're going to standardize systems and processes. We're going to show that as we roll forwards, as we kind of, exercise our ambition to open more of these places, we're going to show that we are using similar points of sale systems, similar stock control systems, similar cash processing systems, so that there's a way that as the business grows, you can look across the group and see standardized metrics. Strategic planning for the capital raise. What do we mean by that? We mean, how many restaurants do we see that this could open? We've opened one. Excuse me, we've opened one, but what do we think is the scope of this? And therefore, how does that scope show when we put together our business plan and show it to a potential investor? And then how do we value our business and how do we value it going forwards? The valuation is going to be based on a lot of different things, on its ability to scale, on its robustness as a concept, that on a good day when everybody's turned up for work, it's great, but on a bad day when a few people are off sick, can we still make it work? That's a robust restaurant business. The quality of the financial modeling that you're going to hear a lot about today from Dimitri, and the investor materials that are produced to show an investor as much information as possible in the best light. So when we look at Cafe Caroline, what we're showing you here is a sort of an illustrated P&L. So we're going to show, so we're saying that the sales per year are around 2 million, around 40,000 a week. The COGS, the cost of goods sold, about 25%. It's a pretty standard metric. Labor, 35%, also pretty standard metric. By the way, one of the things I tend to do is I tend to think that those two numbers are sort of interchangeable. You know, there are some restaurants that we're selling mainly steaks. So actually our cost of goods is slightly higher, but our labor therefore needs to be slightly lower. So in that case, those two metrics can be sort of interchangeable or blended. But what you can't do is you can't exceed the total of those two numbers. So put those two together, prime cost margins end up being about 55, 65. Your rent is usually at around 10%. That gives you an EBITDA of around 15 to 20. That's a pretty good place to start, to say we've got something that we can raise money on to scale. At this point, I'm going to hand over to Dimitri, because these are the main points that he's going to be looking for when we go to him and say, we've got Cafe Caroline and we think we'd like to raise money. So over to you, Dimitri.
Thank you, Simon. So this is the part where we're really trying to combine the qualitative and the quantitative factors of your business. And we've included just some absolute snippets that are relatively essential when you're looking to scale to your second to fourth location. There can be a combination of some of these in whether you have one of them or you don't have the other, but working towards these type of benchmark metrics in the dark blue, dark purple boxes is essential. And then the qualitative items is often how we're going to build the presentation materials. So we often look at, how popular is that one location that you have created? What is the management team's track record? So if you want to highlight a very strong general manager or yourself as an executive chef or as a restaurateur, then that's really important for us to showcase the track record, as early on in your growth, investors are really going to focus more so on the track record and your ability to raise money in the market later on, and also to just provide that credibility to investors that you have built a good prototype and that you have had some experience at other restaurants in your career, that you are able to run a bigger operation, or at least hire a general manager who has that experience as well. We do like to advise clients to really hit that lower than 10% occupancy or rent cost, as it really allows you to provide value across your business. So whether that's offering better value through your menu to customers, or to being able to pay your staff more and attracting higher quality team members, paying more for staff training, reducing your employee turnover. Another key metric that we help clients with budgeting is the project cost. So are your construction, kitchen, pre-opening, working capital costs before opening your second location at a reasonable benchmark so that you can pay back investors within a decent time frame? Another interesting point that we like to really provide in our analytics to clients is, customer loyalty and understanding from all the reservation systems and POS systems out there today. You can really start building more customer cohorts and understanding your customer loyalty at a much more sophisticated level than perhaps in the past where everything was done a lot more manually. So we do like, particularly in a concept like Cafe Caroline, to see a high percentage of return customers, as that provides that consistency that investors like to see as you're opening up a second location. I'll move it back over to Simon, as his experience goes firsthand into growing into the second, third location.
So when you think about your second location, there's a lot of things to think about. So you've got to think about the rent and the lease premium. The lease premium is something that's quite specific to UK. So when we have, if theoretically the rent is slightly lower than the market is expecting, so therefore the current owner thinks they can charge a premium. It might also be that the restaurant has come already slightly fitted out. Excuse me. So therefore, you might have to pay a bit of a premium, but that should come off of your development cost because some of the work has already been done for you. Maybe it's already got, it's got the aircon, it's got the extract, it's got decent loos, it's got all of those things. So there might be a bit of a premium. Rent is 1/10 of turnover, roughly speaking. So when you look at that site, if an agent takes you to look at that site, the first thing you look at, so we already said Cafe Caroline, the existing one, is taking about 2 million a year, 40,000 a week. So you look at that and they're talking about 200,000 a year rent. And you look at it and you think, yeah, I can make that work based on the first one, providing you think that this one is similar. You're thinking that the existing concept, the first one, is pretty replicable. It doesn't have to be absolutely 100%, because it might be that the first one doesn't have a bar, but this one's got an opportunity for a bar. So you might add that in, or the other way around. Is it a site that's more complicated? Is it a site that maybe is on 3 different floors? The kitchen's in the basement. You're going to have two different floors, an open kitchen somewhere, various things. Is it going to be easy to run? So if you have to drop down to a skeleton crew because actually Monday nights or Sunday nights are quiet, can you do that? What's the proximity to the current site? Do you need that? This is only your second one. You haven't had time to scale a really strong team. Do you need to be close in the second site to the first one? And sometimes you can get the most beautiful building, but the construction can be a nightmare. Do you need an open kitchen? Will you get consent for an open kitchen? Have you got a good pavement, but you might not get a pavement license? Think about all of those kind of things. That, under the heading of difficult construction is also just difficult regulation issues. We're saying that you should systemize your business. I already touched on this. So there's an awful lot of things in terms of, there's a lot of really useful packages that will help you in terms of your employee turnover and staff satisfaction. That these are all numbers that we can use to show a potential investor how you do your onboarding for your standard operating procedures for back of house and front of house, the restaurant manual that we can check on customer experience, ensuring that you have the right tech stack that we touched on before. Do you have the same point of sale system everywhere that can all send information back up to head office that can then be processed? And do you have really clean accounting books and a strong finance team? Obviously, we care a lot about this, and in many cases we are your team. But if we're not, then this is really important. Nobody wants to see anything that has any kind of questions over it.
Okay, thank you, Simon. Now we'll switch over to really the core offerings and guidelines we help with clients across strategic planning. Particularly using our Cafe Caroline example, we wanted to go over the standard phases of capital required to expand a concept and what provides investors later on the confidence that you've built a scalable multi-unit concept. So here we're going to go over the 4 phases, which really, once you've got that one prototype that you have raised through family and friends, for the second one, you'll probably go back to the similar pool of investors. You'll go to family and friends, you'll go to angel investors, and you'll go to hospitality-focused investors as well, if possible. When we help clients with raising funds one by one, we help with an underwriting model, which we will share with you shortly, some examples using the Cafe Caroline example, where we really try provide investors with a two-step process to mitigate their risk. So as your restaurant stabilizes through a ramp up or a period where EBITDA and free cash flow is stabilized, then you can start returning back capital to investors as an accelerated rate up until they get their money back. Once they get their money back, then you can offer a cash flow stream after payback that is more beneficial to you as the founder, the chef, or the restaurateur for your concept. That again provides confidence to investors that you are returning back their capital and you're starting to generate enough cash flow to have that self-funded expansion by the time you reach location 4 or 5. Then you reach a point where you are generating enough free cash flow as the founder of your concept, where you can start to decide between raising more debt, so you avoid equity dilution, or you go to growth capital investors, perhaps a little further down, lower down the capital stack in comparison to private equity investors. Option 3, step number 3 over here is really a pivotal moment for you to decide, do I already want to start diluting my equity, or would I prefer to rather have attractive debt terms if I can get them, if I have strong P&L metrics? You may be able to get some favorable loans at that stage if you are around the 10 million and 1.5 million EBITDA stage. Then you start to hit phase 4, where founders are now starting to really understand that they have a multi-unit scalable concept that may get attraction from private equity or even potential hospitality groups for exits. Over here, we really like to provide our clients with the advice of the consolidated model. So where we can really provide them with confidence that they are making an educated decision. We can build out multitude of scenarios for capital structures, performance in upside, downside, or base case, and a very clear understanding of free cash flow. So a lot of restaurateurs often focus on EBITDA or net income, but really cash is king, and understanding the flow through from EBITDA to free cash flow is essential, particularly with CapEx reserve, interest and principal payments, working capital issues in case you have a buildup of accounts payables. And again, we will provide a mini sample with Cafe Caroline on this. Next, we wanted to go over the actual mechanics of what we use to raise money for a single site. So let me just share my screen alongside our presentation. So at Paperchase, we've built a very robust underwriting tool, which we then use to help us with our pitch decks. But we really have almost an institutional investor model here, where we factor in a very robust table of contents, which is all linkable throughout the model. And we build this for our clients with a feasibility study. And then we work with our clients so that they also understand their metrics and they can provide us with any feedback for their site. We start with our cover tab. We build out our project costs. For Cafe Caroline, we are expanding the second location into Chelsea, London. And we move into our intro details, where we put in the basic metrics of the restaurant information and our landlord information, our timeline information, which then yields a standard fact sheet, which investors love to see, which is a one-pager document. And it has very good comparable metrics that we can use to assess how successful the site could be, what could be improved, and what is really a highlight that we can then put into our pitch deck. We then have a dashboard which investors, again, look at all the key metrics. And the most important is the project payback in a select amount of months, the type of IRR and cash multiples that invested would receive for the second location. Now let's have a look at our pitch deck. So again, looking at Cafe Caroline, once you've created that holding company for your concept, and now you're looking to create an investment memo for your second slide. Over here, this will be shared again with angel investors, family and friends, with the goal to raise cash flow for this particular restaurant. Here we have our standard Paper Chase investment memo, which can be customized to fit your brand and your concept. We start out with a very simple executive summary, and we start defining the concept and the locations that are part of Cafe Caroline. We really like to have a snapshot to show investors, what are the key highlights? What should they really care about? What is the IRR? What is the cash multiple? What is the basic economics of the site in a really quick snapshot that they understand what they're dealing with. Again, really important is sources and uses. So what is it gonna cost to get this up and running? We use about 8 to 9 key uses, particular focus on the pre-opening expenses to help our clients understand, do they have enough in the training and pre-opening phase to make that second location successful. Again, here we link a pro forma highlight section where we can analyze and show investors how quickly we're going to pay them back, and they get a good understanding of EBITDA and gross sales with some comparable metrics down below, particularly on sales per square feet. Then again, as we mentioned, we will show just a simple qualitative overview. We often add a lot more color to our clients in terms of social media, articles, press, both on the concept, both on the chefs, both on the general management team. But we really want to add as much color as we can and as much positive press as we can about, again, this is an example, but we would customize this to your brand and concept. Finally, and most importantly, we do have a management team section where we want to showcase the talents of the executive chef. We would include all the logos of past experiences or any awards, and we like to, again, customize it to our concepts and clients to really show them in their best light. Once we have created those materials and you do go through your fundraise for your individual sites, once you get to the second, third, fourth location, you're going to start getting to a free cash flow and cash balance level that will allow you to get to that institutional investor phase. Before that, it's really key to have an advisor by your side that can create investor level reporting so that you can communicate with your investors at the right cadence and at the right level of detail. So investors are going to like to see either a quarterly or a monthly report, and also transparency into their ability to get that distributable cash flow back so that they achieve their payback period. And if you've offered a preferred return or a convertible loan, so that they understand when are they going to get paid back, how much money are they really making from your investment, and just having that level of communication with them, with the support of a firm like Paper Chase, really provides that credibility that is quite necessary in the restaurant industry. As we all know, we are considered a higher risk industry. So trying to mitigate all of that risk really helps investors feel more comfortable, particularly now as we move on to the institutional investor slide. So now you've built that confidence, you've built that free cash flow balance, you've built up your reputation across a closer group of investors. And now naturally you're considered close to a multi-unit concept if you scale to 6 to 10 locations. I'll let Simon touch on this as well after the slide a bit, because he has firsthand experience going through all these phases. So that's why it's important to get to this phase where you can start to make some more educated decisions on debt capital, or you start taking on a little bit higher pressure capital from institutional investors, which may push you to grow at a level you may not feel comfortable with. So there are pros and cons to both forms of capital growth. We do like to stress to investors, what equity dilution does mean to you is important to consider, particularly with the type of investor that will be your partner. It's important to make sure it's with a good fit and that you have adequate leverage when taking on an investor, so they do not really change the vision of your brand, or that you feel comfortable with the vision of your brand moving into a larger scale. Using debt is a good vehicle as long as the business can support it. This avoids dilution. Again, having Paperchase by your side allows you to be very on top of your debt covenants, your debt service coverage ratios, your fixed coverage charge ratios, and your overall EBITDA to debt balance. So again, our consolidated models will help you go from single location models to adding them all up together in a 3-statement view, so that you can really review all the scenarios on your business when you're adding debt capital, equity capital, so that you can see your cash flow statement and your balance sheet in a clean document, 3 to 5 years down the line. This is really what our clients like to see. And we can often put upside and downside case triggers. So if something had to, like COVID happened, of course, that would be a severe downside case. But let's say sales drop 20 to 25%. We will build that into your model so that you can say, okay, this is how much cushion I have to still meet my investor or debt covenants. And I can be prepared to present to them, in a board meeting or in an ad hoc investor meeting if something is going on with your business. Next, I wanted to go over, the core offerings that we help with at Paperchase in a bit more detail. So we have gone over the Excel model, which is that prototype financial model we did showcase for Cafe Caroline. And generally, this model is very useful for our clients in terms of either creating a pitch deck alongside it, or it can also be used just as a PDF to share with investors. But it really is robust enough to handle day part analysis, down to the hour, down to breakfast, lunch, or dinner, down to your table turns per day part, down to the seasonality of the months within the year. And also just to have different phases of your revenue centers. We can customize it to show 4 to 5 months of summer in the patio. We can put in private events for hosting VIP events, or having certain minimum spend limits for certain revenue centers. So we've really built an industry grade model that can withstand investor due diligence and getting you to that next phase of growth. We also help with the consolidated model. So this I already touched on, and what is used to in your data room during due diligence, where you're going to show some historical information and forward-looking information as you grow through locations 2 to 4 and 5 through 10. Finally, you've also seen an example of an investment memo or a pitch deck. You can also reach out to us after this in our Q&A or by email, and we have other samples that we can share. We just didn't want to share client information on this webinar, but we have already worked on about 30 pitch decks and investment memos for our clients this year. So we've really built up a lot of work on this end at Paper Chase to start bringing our concepts and our clients to life and building that visual information at a summary level that investors like to see. I'd like to just move it back to Caroline, just so that we go over some Q&A, particularly on, all the stuff that we have shared today, especially the phases of strategic planning and how you move from one by one over to the consolidated and institutional section.
Thank you so much, gentlemen. So we can open up the chat for any questions that you guys have related to this topic or anything else that Simon and Dimitri can speak to with their experience. So if you have a question about your specific restaurant or just in general, please go ahead and drop in the chat, or you can raise your hand and I will unmute you. Alrighty, I see one question so far. It's what are some of the red flags to look out for when you're looking at a new space?
Okay. Simon, did you want to take that one?
Yeah, I think I sort of touched on this, but let's kind of go over it again. So what is your concept and how would your concept fit into the new space? Restaurant people are dreamers usually. I mean, we've sort of got this. So the first Cafe Caroline is, it's 3,000 square feet, all on one floor. It's really easy to operate. But the next one we see is on 4 floors, but we love it. The building is brilliant, and we think we can make this work. You're really building in a lot of heartache and a lot of extra cost because you've got to have staff going up and down stairs. You don't know where anyone is. Your customers are finding it harder to find the toilets. They're finding it harder to find everything. Now, it doesn't mean to say you shouldn't take it, but really, you just got to really consider all of those things before you do. And there might be extra cost in terms of the development of the site. So what should you be looking out for? I suppose the answer is look out for everything. And, that old phrase, location, location, location. Whatever you do, there's still a good chance you'll get it wrong. So all you can do is try and mitigate that. Try and get as much right as you possibly can.
I'll add a touch point on that as well. At what we help our clients with the underwriting stages, we also help with lease comps at the commercial retail level. So if you do have a site selected or you're still selecting your site, we will look at the local market that you are interested in and build out those lease comps for you so that we make sure that, your property agent, or if you're looking just yourself, is looking at an attractive lease for your new location.
And we have a question from Steve. Steve, I'm going to let you talk, and you are live on the air. Go ahead.
Hi, can you hear me?
Yeah, perfectly.
Yeah.
Super, thank you guys. Brilliant presentation, very, very impressive. A lot in there that I'd like to take further. But I do have one question for now. In relation to the second site, I've often had sites presented to me, which are great. But I've always been conscious that there's a gap between identifying a site, doing our due diligence on that site, making the landlord come into an agreement of what sort of offer that would look and feel like. And then the gap between that and then setting up, an investment deck, getting everything lined up, the time it would then take to secure investment while still hoping that site's going to remain available. There's quite a huge void there. And I'd just like to know, I'm assuming that if we prepare correctly, working with you and have everything lined up except for that site, and when a site becomes available that we're very keen on and we do our DD, that we can then possibly just slot that in and then go out to a pre-selected bunch of angel investors, friends, family, etc. Would that be right?
Yeah, what you just said there, Steve, is exactly the way that I would recommend it. Because So what I used to do was I would go to an agent that I knew, that I trusted, that I was probably going to end up working with, and I'd say, "Can you give me a couple of sites that maybe have sold already? It doesn't matter, as long as they were recent transactions, and maybe something that's available now that I really do like, but you know, sorry, excuse me, but I don't actually have my heart set on it, so that we can start to go so we can start to put together the deck. We can go out and find those investors, and they all understand that actually what we're looking for is we're looking for £1 million or £2 million or whatever that number is, that's going to give us the next three sites. And those next three sites will look a bit like this. Probably not any of these individual ones, because they probably won't be available, but that's kind of what we're looking for. And then broadly speaking, you've got the money. I mean, the money might be dependent on various things, depends what that particular investor might be saying. They might say, we want ultimate sign off, but me, Dimitri, will be trying as hard as possible to make sure that the money comes with the least number of strings. But broadly speaking,
Understood.
what you said is exactly right.
Superb. Thank you very much.
Steve, we have a question from Michael. He asks, with the headline COGS/staff/rent percentages, are these figures net or gross of takings?
They are net.
Michael,
net. Yeah.
Yeah, you're asking well, that's in the deck. Yeah, everything's net. We don't count VAT because we don't own it.
Right. And then we have a question from Armand. He asks, are there minimum requirements needed for raising capital? Sorry.
I could take this, Simon. But yeah, moving back, even Caroline, if you wanted to bring up the bringing your concept to life or the prototype slide, just so that we all have a refresh. Perhaps the prototype, or actually bringing your concept to life is also valid. Yeah. So we would say you want to raise capital at favorable metrics so that you're not under pressure to raise capital. Of course, if your concept is not performing, then, from an operation standpoint, you should try to improve your metrics to get to this stage. But really looking at these kind of benchmark metrics, so sales per square feet, ideally you do want to be above about 1,000 sales per square feet per year for your concept. That just shows that, you have the volume of sales to hit 15 to 20% of EBITDA, and that you have enough utilization amongst your seat count. So you want to have that volume in there. You do want to have rent between 8 to 10%. So again, you need the sales volume to achieve that with your rent cost. And then you do want to show a relatively low project cost when you are raising capital early on. So you want to be savvy with your construction budget, with your furniture budget. Can you be creative early on to lean on contractors and suppliers to help you get off the ground? Of course, if you have higher metrics here, like I mentioned in the presentation, you need trade-offs. So if you do have relatively amazing location that isn't actually going to be 10 to 12%, you better have higher sales per square feet. But the minimum requirements, as we mentioned, are really the benchmark is 15 to 20% EBITDA to have an effective fundraise.
And Dimitri, I think Arman was asking about a minimum number. Do you think there's a minimum?
In terms of, yeah, I guess minimums in terms of capital, or you mean?
In terms of capital.
It could be £100,000 if you can get, a shell that's ready to go, or it could be as high as you need. There is no real minimum, particularly with family and friends. We've helped clients that only need £200,000 to open up their second and third location, just because the site is this Goldilocks space that we have in here. And of course, that takes a lot of pressure off investors, and it's a lot easier to say yes to a low project cost. So there is no minimum. It depends on your concept, and really how what the economics are to get to 15 to 20% EBITDA.
Yeah, let me add one thing. Let me add one thing to that for Armin, is that the minimum is what you should always be going for, because it's something Dimitri and I were talking about this earlier, that in the beginning, equity feels cheap because it's not costing you anything. But as time goes on, if your business is successful, it's the most expensive funds you're going to raise because the equity is the most valuable, assuming your business becomes successful, which is the whole point. So really, what is the minimum? The minimum is the number that you should be aiming at. So you're always trying to raise the minimum amount of equity-based funding. But once you've got a business that has some equity value, then you should also come to us, because we can also help you present to a bank where you're raising debt funding, but we're showing you in the best light. So actually, it doesn't truly answer your question, but it's a sort of that's the kind of the bones of it.
Michael asks, with the development of a shell and core site, with the initial investment to build out a unit, how do you suggest to, I don't know that we got the full question there.
Michael, why did you come on the call so that we can...
Michael, let's chat live. Go ahead. What were you trying to ask?
Sorry about that. I kind of got distracted halfway through the question, and I didn't realize it got sent. So the development of a shell and core unit. I've got a unit that we're expanding to basically the unit next door to, and the build out costs are just climbing with all the boring MEP stuff. So I'm just trying to figure out with an investor, how do we, if it's becoming sort of closer to £1 million that we need to sort of raise. I was just looking at different options on paying that back. You did touch on it initially in the presentation, but it's this is the first time I've ever sought investment. So it's
Michael, can I just ask you a couple of questions?
Of course, can.
When you say it's shell and core, is there are they building it out at the moment? I mean, is the landlord doing any work on this building?
So we've got an old bar unit that is finished and is operation at the moment, and we're in that now, trading quite well. The next door unit is sort of is a lot bigger and allows us to sort of expand and add in more. It's more of a sort of like food hall / comedy club. So they've given us a capex contribution, but
okay.
It's just as we're sort of getting further down the line with the final bits of the design, which is airflow, HVAC, all of this sort of stuff.
Yeah.
It's just we're finding there's sort of other little
issues. The reason I was asking you if sometimes you get yourself into a situation. I mean, an obvious one is something like let's say a shopping center. I mean, I use that as an example because the landlord has got people in there doing fit out. He's got shop fitters, builders, and so on and so on. Inevitably, they will do that work much cheaper than you do. But what I found in the past is quite useful is to agree a number with the landlord, and that will increase your rent. But let's say, for argument's sake, you need to spend £1 million, and they're going to charge you 10%. That 10% is often cheaper than you could build it for, from 2 points of view. One of them is it effectively becomes more borrowing because it's been added to your rent. The second is they've done it at a cheaper rate than you could, because they're a different kind of builder. So I'm only wondering if that applies to you at all. Is there anything going on in there that you could ask the landlord? I mean, I accept what you say, that he's already given you capital contribution, but does that mean there's no other work going on?
So it's office block with retail units on the ground level. So there's always work going on in here. Like, we haven't signed the lease, and there's definitely room for renegotiation. And when I've sort of brought up things, that they've indicated they'd rather look to increase that capex and sort of have us handle it rather than do it themselves. But I do know that for some of the office units above, they are doing work, and it is something that is a bit more something that they would be open to, because I've got a colleague or friend who's taking a unit on one of the top floors.
Well, if you go down this route, if you go to them and say, look, I'll pay you more rent, but could you do the fit out? You've got to balance that with, if you pay more rent, you may be damaging your own profitability. So you've got to balance that, but it's just another thing that you can add in. You know, raising funds comes in all sorts of shapes and sizes. So getting a bit of extra money from the landlord and for a bit more rent, providing you think you've got the headroom to do it, it can sometimes work.
No,
Otherwise,
it's definitely something I hadn't really thought about. Maybe it's something we go, look, cool, can we have a bit more of a capex contribution, but we all agree to this rent or these increases over the next 10 years, whatever.
Exactly.
Okay, thanks.
And then otherwise, I mean, you know, how do you raise the money for it? You know, you just have to believe in the fact that this is going to be profitable, and then it's worth sitting down with Dimitri and just saying, look, I really think that this is going to take, you know, another 1 million a year or another 2 million a year, whatever that number is. And then he can start to put that into a deck and say, you know, this stacks up. And you've already got a bit of a track record because you're trading next door. So there's savings you can make. You're not going to repeat every member of staff. You're not going to repeat all the management. And so, you know, it often stacks up if you've got something that is really close to you proximity wise.
Yeah, no, I mean, it would really allow us to do more of the corporate stuff that has. Anyway, look, I'll talk to Dimitri rather than turn everyone's ear off.
Brilliant.
But yeah, thank you. I thought it was very useful.
Thank you, Michael. We've got a question from Steve. Steve, you are live on the air.
Thank you. Just me again.
Hi, Steve.
Incidentally, hi all. Incidentally, the figures that you was using as the example are very, very similar to ours. We turn over a bit over 2 million a year, which is low for us. We are 1,600 square feet, sorry. So we hit certain parameters in your COGS. However, our EBITDA is not sitting at 15-20%. So the question is, and I really, really like, once again, what you guys have put together, and I'd like to take this further. As part of the next steps of initiating a call and taking this further forward, would you assist in, and Paperchase clearly do our management accounts. We fortunately get even weekly accounts now, so that we can really, really hone in on the numbers. But as far as the benchmarking goes, as to, you know, a company turning over a relatively small venue turning over 2 million a year, isn't as profitable as should be. Just curious as to whether or not you can assist in that regard, as to, you know, eyeballing the numbers and saying you're spending too much over here, marketing costs are way too high, your labor cost. I mean, I think we're within the
Look,
right.
If you look at this particular slide, thanks, Caroline, thanks for that. If you look at this particular slide, so one of the things that I touched on, and I feel really quite enthusiastic about this after 40 years in the restaurant business. There's only a couple of numbers that I really care about. And, you know, if you've got a 2 million turnover from a site of that size, in my mind, you're doing really well. Now, unless the rent is killing you, can you tell me what the rent is?
100K. It's
you got a great rent. So the rent's like rent's like 5%. So it's not rent. So now we're looking at
your rent and rates are 150K. So it's still below the 10% mark of the turnover.
Yeah.
now it's got to be either it's either your food cost, your drink cost, or your labor cost. There's nothing else left. So
Yeah.
somewhere in there, it's anybody can run a restaurant, but not everybody can run a restaurant and get those numbers right. So for me, I've always tended to want to give my customers value. So I tend to give the value on the plate. So I'd rather give you a steak that fills your plate because I only need one guy in the kitchen to cook it than to give you something that took a much bigger process and there are 6 people in the kitchen and I'm looking for a Michelin star. That's just not my skill. So
Yeah.
somewhere in there, that's why I said that those numbers, the cost of goods and the labor cost, they're kind of interchangeable. Now,
Okay.
Dimitri has put them there, saying that they add up to let's say up to 60%. I personally aim for 50%. Now, you'd very rarely get to 50%, but I think if you aim for 50, then you're going to be a bit closer to something that guarantees you're going to make money. So what do I mean by that? I personally would be aiming at a food cost of something like 30, and I'd aim for a labor cost of something like 20. Now, there's a couple of points of margin in there. The food cost might be 32, or it might be 28, but
Yeah.
something that gets me close to that, and then I've got a healthy business. And then if I take that business to Dimitri says, no problem, I can raise money for you. So my job as the operator is I've got to have that robust menu that says that, it's not highly skilled. And on a good day, we turn out brilliant food. And on a bad day, it's pretty damn good. And it's robust. And then I can take that business to Dimitri, and Dimitri says, yep, I can raise money on this.
Okay.
But I'd be happy to talk to you offline.
And
We can, you can pick up the phone to me anytime. And, I'm very happy to kind of have a look at your menu, talk you through it.
Okay. Thank you very much.
Yeah, pleasure.
After this, thank you so much for your question, Steve. Anybody else? Questions? Go ahead. Don't be shy. Doesn't necessarily have to do with this. We've got 2 experts on the line that know a whole lot about a whole lot. Michael asked, can we get a copy of the recording of this webinar? Absolutely. After this webinar, I will be sending you
10,000. It's £10,000 a time. Is that okay?
We'll be sending you all a recording of the webinar afterwards via email. And Michael also asked if he can borrow 10K.
Yeah, good question. Can I just touch on something as nobody's asked it yet? So something that I'm always aware of when I'm speaking to Dimitri is an absolute expert in what he does. And he's very good at knowing the other side of this. So he knows who he's speaking to. He knows what the investor or the lender might want. Our side of it, the restaurateur's side of it, I think it's worth trying to think through the various stages that we go through. Now, I know that for me as a restaurateur, I'm good at kind of, you could say, stage 1 and stage 2. I'm less good after that because I get, it's less interesting to me. So what do I mean by that? I like the idea of coming up with a concept, and that concept, maybe I think to myself, if this works, so call it Cafe Caroline. If this works, then I think it could be 50 strong. We could open 50 restaurants. Now, what I'm going to do is Cafe Caroline, the first day I open it, it's one thing. By the time I get to restaurant number 2 and restaurant number 3, it's subtly changed. There are certain things that I've realized didn't quite work. By the time I get to restaurant number 4 and restaurant number 5, it's really bedded down now. And I've got systems in place and I can see what's working. And in my experience, I get to restaurant 8, 9, and 10. I don't want to go any further. I now want to kind of let somebody else take this on, because the skills that you need to come up with a concept and get to, say, 4, 5, 6 restaurants are different to somebody who can run 20 or 30 or 40 restaurants. They're different. It's just a different kind of understanding of scale, understanding of growth. So I think it's quite important to know who you are and what you're good at.
Steve asks, what is your fee and how do you charge for your services? Is it commission based or is it a set fee, Dimitri?
I can take that, yeah. So we offer two forms of services for corporate finance and corporate finance materials. So if you are looking on a fundraise assistance, at the moment at Paperchase, we are working to handle lower project amounts, but at the moment our minimum is £3 million to help on, just because of the time it takes to raise capital for investors, and we also vet the deal ourselves in terms of how achievable the fundraise would be. And generally for that, we would charge a combination of a retainer to create the model, the materials, the FAQ set, the investor list. And then if there is a successful fundraise, we would charge a commission based. Again, that's on an ad hoc basis at the moment. And then we also do prepare just the material. So if you are under that 3 million threshold, we can just still help you prepare the financial model, the underwriting, and the investment deck. And that's also just on a project basis fee to get the materials done. Some clients also then transition to FP&A or CFO services per month so that we can maintain that cadence with investor reporting and overall like board deck presentations, so that you don't have to build all those PowerPoint or Canva level presentations yourself.
And then Michael asks, with the launch of a new site, what is the launch marketing budget percentage that you would apportion to that launch?
We generally prefer a range over here. We do think marketing's ever more important in this new age of restaurants, but you can also do a lot of organic marketing. But generally you want, at least about 15 to 20 pounds per square feet. So it will end up being roughly about 25 to 30,000 to build out your pre-opening marketing budget. But again, it depends on the scale of your concept. That's why we do look at it at a per square feet basis. So yeah, right around that 10 to 15 to even 20 if you really wanted higher end designs for your concept.
Any last questions from the group? Anything that you want to ask? If you're too shy, I will copy when I send you all the recording. I will also copy in Dimitri and Simon, and so you can just reply all to that, and they can take any further questions. But if you have any last burning questions, we'll take them now. Otherwise, thank you guys so much for joining us. I know that you're all very, very busy, and so we really appreciate your taking the time to talk with us today. Like I said, I'll be sending you all the recording, and Dimitri and Simon will be on CC to answer any questions that you have. If you want further information about how we can help you raise capital or put together investor materials for your next expansion, we'd be happy to do so. Thank you so much to everybody for joining, and have a wonderful rest of your day.
Thanks all. Thank you.
Thank you, everyone. Thank you, Caroline.
Is that it? Are we